everybody? It's Jonathan Bunk, and we got our guy Hugh over here for the next episode of Hugh Knows. And we also got a special guest today, our Padre, the head of EVP things here at Network Funding, Rich Jefferson. Rich, why don't you say hi real quick?
Hey everybody, glad to be here.
Thanks for coming,
Hugh,
Rich.
I'm excited. I've watched several of these. You guys do a great job dropping knowledge on folks.
Awesome.
Yeah, so usually we start off every day, every video with a little disclaimer. You know, we run a branch here for Network Funding in Houston, Bunk & Baker Mortgage Group, and Hugh and I and the different visitors we have work for our branch and share our opinions that are really not affiliated with our parent company, Network Funding. But today we have somebody with corporate with Rich. So anything you want to say around that, Rich?
I'm going to give you all the information that I know to the best of my knowledge.
Great. Yeah.
There we go.
And the other thing I'd say is that we're shooting this on June 15th, so you might be seeing this a few days later when we post it online. So if some of the data has changed, just bear in mind that we're shooting this at a point in time. So let's jump into it, guys. So the first thing that we want to cover is what has happened with the Fed meeting. So the Fed met over the past couple days, so we wanted to talk about that. We wanted to talk about the CPI report that came out this week, which showed that inflation continues to slow, so we're excited to see that news. We also want to recap what happened with the debt ceiling, what impact did that have on interest rates, and then we're going to pivot and talk about what is the dilemma that the Fed is facing right now. They have some difficult decisions to navigate. What are those factors? And we'll talk briefly about that. Then we'll jump into the Houston market update, what's going on in Houston so far this year, and then we're going to end with some wisdom from Rich as he shares some knowledge from his years of experience in the industry. So let's jump in and talk real quick about the Fed's meeting. So on this slide, I'm basically showing a couple of different data series. So the first one is the red line. That shows the federal funds rate. And this comes from the Federal Reserve's dot plot, which is basically the Board of Governors puts out their projections of what they think interest rates are going to be. And at this last meeting, the Fed said that they would pause interest rates at this meeting, so they did not raise interest rates, so they're still at 5 to 5.25 right now. But in their dot plot, which is this projection, they indicated that they may increase the federal funds rate 2 more times, 2 small increases for the rest of the year. So that basically increased where they were previously, which was at 5% to 5.25%. And because of that, we've seen the market adjust its views. So previously, if you look back a month ago, you can see in the blue line, this is what the market was saying that what they think the Fed is going to do.
Yeah.
And a month ago, we were going through the debt ceiling stuff. But as that has transpired, and then obviously after yesterday, the market has shifted its view up to where it's much more in line with the Fed. So that's what you can see in the green line. And so now the market is basically in line with what the Fed is saying, that we probably won't see cuts this year, and in fact we might see a couple of raises.
Yeah, that sounds a little doom and gloom, but can we just celebrate that the Fed finally paused?
Yeah.
Can we
Amen.
get a little,
Well, we can celebrate the fact that
They
things
paused.
are actually working, right?
Yeah.
It wasn't a year ago, we were at 9.1% on the
Yes.
CPI,
Yes.
and we got a reading of 4 yesterday.
Yes.
So that just empowers the Fed to keep doing what
Of
they're
course.
doing, because it is working. It's for our
Medicine is
business
good.
and for the real estate business, it's definitely slowed things up a ton. But we're just we are a big piece of the economy, but
One part.
one part of it, but a really big piece of it, it'll pick up.
Yeah.
The demand is here.
Yes.
So once we get through this, get some price control for our everyday expenditures,
Right.
Once we get that under control, things will loosen up.
Yeah.
So that was nice. Now you've got other Fed members talking about maybe 3 more. So you've got some really hawkish people, and we'll see what happens.
Yeah.
Right now I'm thinking it's going to be 2, but what they did say is no cuts.
Right.
That's why the market
That's why the
got a
market
little
reacted.
upset yesterday.
Yeah.
Yeah, and what we always remind people is the federal funds rate that the Fed sets doesn't necessarily directly change mortgage rates. What changes mortgage rates is what the market expects, what the bond market expects, mortgage-backed securities. So that's why on this chart you see what the market's expecting a month ago today and what the Fed funds rate doing. And so for the last couple of months, the market's kind of been calling a bluff, like, oh, the Fed's gonna gonna cut. And now the market's like, all right, our bluff is
Maybe
off
not.
the table. We're listening to the Fed.
Exactly.
And so I think the market's starting to get in line with what the Fed is saying.
Right.
Well, people are starting to see the results.
Yeah.
So that helps give credibility to what the Fed is doing. So.
Right. Yeah. 100%. And I mean, the good news is you're starting to see, at least on this chart, you can see that by the end of the year, we should start to see rates come down, or at least by the beginning of 2024, and that's what the Fed is indicating. So that is good news. So let's move on to the next segment and chat real quick about inflation. So the CPI data came out this week, and basically, like Rich just said, it showed that inflation has been slowing continuously, really, since about the middle of last year. So you can see here, I'm showing the different components of CPI, shelters in the red, and then the energy component, the other, which is comprised of services, and then the food. And so you can see how those different components impacted inflation over time, and you can see that as the Fed raised interest rates starting in early 2022, we've started to see those prices come down, which is great news. That's exactly what the Fed is trying to accomplish. Of course, we're still above their target. You can see that in the dashed line, that 2% level. So we're still, double that, but we have made a huge amount of progress since last year. So this is very encouraging.
Yeah, one of the things I would say, we always tell people when we look at this chart, is like the Fed didn't start hiking rates till May of 2022, Rich?
Yeah.
Mm-hmm.
And you look at where inflation was in November and January, it's like it was at 4, 5, 6%, and the Fed's like, we're not going to take any action yet.
Right.
And then finally in May of 22, they started taking action, and we went up fast.
Yeah.
And then you see the impact it's had on inflation. And so even though the Fed acted late, they acted, and it's working.
Yeah, and we can actually see that action on this next slide. So here I'm showing the 30-year fixed mortgage rate in the light blue, and then the federal funds rate in the green. And you can see that the federal funds rate, basically, right as COVID started to kick off, went down to almost 0%, and that really helped mortgage rates come down, and really probably to some of the lowest levels we've ever seen as ever. And but inflation was already started taking off in the second half of 2021, and you can see in that green line that that's the federal funds rate, and it basically remains flat until you start to get into Q2 of 2022. So that's why they've had to increase rates so quickly. We think that they were a little bit delayed in responding to the inflation situation, but because they were delayed, they've had to be very aggressive in order to get it under control. And as we saw on the previous slide, what they are doing is it's having
It's
a good
aggressive
effect.
and it's working.
Yep.
Yeah, and Rich, a lot of people watching this podcast, might be realtors or buyers, and they're like, I wasn't in the market in 2010. I wasn't even paying attention to real estate in 2019.
Yeah.
Now we're in June of 2023. You mind just, shooting a quick narrative here of what's happened 19 to now?
Yeah, for the newer agents in the market that weren't around during that COVID period, they didn't know. Like, they didn't understand. All they know is rates are high today.
Right.
But compared to what?
Right.
Because we were just in 2018, our rates were 6%.
Right.
Yeah.
Like, we're at 7 today.
Right.
It's not that much higher. But that was a manufactured period. The government manufactured that period of time, brought the rates down to keep the economy humming during all of the craziness that we went through.
Lockdowns,
So it was manufactured. It was a manufactured event that we're not likely to see ever again.
Right.
So we just need to, for the people that have been, the agents that have been in this business for a long time, that was a great period for everybody. It was great for buyers, great for sellers, great for agents, great for mortgage people, great for our economy, but it wasn't sustainable.
Sure.
And so what we're experiencing is it's a little payback.
Right.
Like we're paying the piper
Give and
now.
take
Right?
this
Yeah, we're
industry.
paying the piper, but I just don't want people to lose perspective. You can't look at 2 years ago at the rates and say our rates today are terrible.
Right.
Our rates today are still better than they were 10 years ago.
Right.
Today's rate, Hugh, like, people just lose that perspective.
Yeah, and I looking at the data back to 1970, the average 30-year fixed mortgage rate is almost 8%.
Mm-hmm.
So we're actually below that long-run average right now. So relatively or comparatively, it seems like we've come up a lot. But if you look at it on a broader perspective, when my parents were buying a house in 1980, interest rates were 15, 16, 17%.
Yeah.
And so that's what I tell people. It's like, they were able to get into a house, start to build wealth, eventually own that house outright. And so it's still possible, very possible, I would say, even relative to, back to the 1980s to do that today. So
Yeah, wages were lower, prices were lower. Like in '80, I think the average sales price for a home was somewhere around $65,000 or $70,000. It's pretty low. Now today, what are we at?
That's what a car
400?
costs, Rich.
right.
In this market,
That car costs
we're somewhere around
$67,000.
$420,000
Right.
Yeah.
average sales price. So
That's wild.
that hurts when the interest rates are still below the average over the last 30
Yeah.
years, but your price is
Right.
higher. And that could be a whole nother episode of this podcast.
Sure.
But we do need we need more affordable housing for people.
Yeah.
For first-time home buyers. That's it. I mean,
Absolutely.
we have to have it.
Millennials are entering the market, biggest cohort
Yeah.
ever of that prime buying age for houses. So definitely need more inventory.
Yeah.
And we're seeing that certainly in the Houston market. So just pivoting to the next section, we wanted to recap what's going on, what happened with the debt ceiling. So on this next slide, you'll see the 30-year fixed mortgage rate going back to November, which is when we saw rates peak at around 7.5%. So what I'm basically trying to show is that in the sort of May time period, we were around 6.5% for the 30-year fixed rate. And as the debt ceiling negotiations started to dominate the news cycle, and as this started to drag out, we saw rates continually start to rise. So you see that blue line as we get into the later part of May gets back up almost to 7.25. Once the debt ceiling negotiations were resolved, we did see rates come back down, but they didn't come all the way back down to May levels. And I think there's a couple of reasons for that. One is that the jobs report that came out, the most recent one, basically showed that the labor market continues to be very strong. It beat expectations for the number of jobs that were added. And then also the weekend before the debt ceiling negotiations ended, the PCE data came out, which is another measure of inflation that the Fed pays particular attention to. And what that showed is that in April, on a year-over-year basis, that inflation actually increased both for the top line and for core. So core strips out the effects of food and energy. So given that the Fed looks at that measure of inflation pretty closely, I think the market was sort of a little bit wary that inflation isn't looking as great as we would like it to be, certainly by the PCE measure. So we didn't move quite back down to the mid-May levels. So that's basically, and we're kind of trading below where we were when the debt ceiling was ongoing, but not that much below. We're kind of in the high sixes still.
Yeah, and most folks that are watching this probably like, what's the debt ceiling? If you remember Memorial Day weekend, there's a chance that government was going to default on its debt, right? And so that's never good for anybody.
Yeah, it happens every 4 or 5 years. We go through this whole
Kick the can down the
nonsense.
road.
Yeah,
Yeah.
it's posturing, it's political stuff, but it's real business. I mean, we do have an issue. We got too much debt as a country.
Yeah.
I mean, that can't
I think
you
it's
can't debate that.
30 trillion?
Over 30
Yeah, I mean,
trillion.
it's crazy.
We're over
So
30 trillion
that
in
does
debt.
need to happen, but where do you cut?
Yeah, where do you cut?
Where do you cut? I mean,
Cut
most
the military, cut Social Security. It's, these are hard. These are hard.
Yeah, I mean,
decisions to make.
they're negotiating over, discretional.
20% of
Yeah,
the
like
budget.
a tiny little piece of the
Right.
budget. I mean, it's still a big dollar amount,
Of course.
but where do you cut? And
Yeah.
that's the whole negotiation every time.
Yeah, but the market doesn't like the extra risks. That
They don't like the
come-
uncertainty.
Yeah, they don't like the uncertainty.
They don't want to be. We don't want to have our credit rating downgraded.
Of course.
Because we're global.
Yep.
And the U.S. dollar dominates. And when you get downgraded, and the safest investment vehicle in the world is the U.S. dollar and U.S. bonds and treasuries, and you get downgraded, now those are not the
Yep.
safest.
That's right.
And so,
So then your yields go up, and then that impacts the mortgage rate. So that's basically just a recap of what went on prior to the debt ceiling and kind of where we are today. So the next segment we want to talk about what the Fed is facing, the Fed's dilemma. So the main, I would say,
Dum, dum, dum.
one of the main issues, if not the main issue that the Fed is trying to combat, is a hot or tight labor market. Okay, so what I'm showing here, I got 3 charts on, but the one I want to focus on first is the top left. And so you can see in that green line, I'm showing the U.S. labor force participation rate. So this is the ratio of people employed over the labor pool,
Yeah.
right? And so you can see that from the early 2000s, that went down. There's some demographic things going on, people retiring, baby boomers entering retiring age. But you can see about 2014 to 2020, we were sort of at a level, right at 63, under 64%. And then you see that sharp drop down in 2020. That's COVID, right? So that makes sense. A lot of people dropped out of the labor force because of lockdowns and that sort of thing.
Stimmy checks,
But
baby.
I think the vital thing to notice is that green line has not gotten back up to pre-COVID levels, which means that we don't have the same number of people in the labor force that we did previously.
Yeah, so employers have a demand to hire people.
That's right.
Yeah.
Employers are searching for people to hire, and there's fewer of them. So what does that do? That pushes wages up, and that keeps unemployment very low. So you can see on the left-hand chart in the blue, I'm showing unemployment back to 2000. You can see the spike in the middle of the 2000s, that's the Great Recession, and then the really sharp spike in 2020, that's COVID. And then we come sharply back down, and we're actually at historic low levels this year, around 3.5 to 3.7%. So what is that doing? That is keeping wages really high, and really all total benefits that you would pay. So on the right, I'm showing the U.S. Employment Cost Index. This is the change quarter over quarter, so they measure it by quarters. The latest quarter we have is Q1. And so you can basically see that after 2020, we've seen upward pressure on basically the cost of employment, and that includes both wages and benefits. And so that's what the Fed is dealing with. They're dealing with, lots of job openings, not enough people to fill those job openings. That's putting upward pressure on wages, and that is a huge contributing factor to inflation.
It sure is. It's one of the bigger pieces.
Right.
Everybody was talking earlier when the Fed started taking action, like, oh, you just want unemployment to, increase. I mean, that is a byproduct
Right.
of controlling inflation, but it's fighting it.
Right.
It's fighting it. I mean, people are more productive. You've got more technology in business today, making people more productive. And, look at what's happening. You've got a lot of people in the workforce. We need more, right? We got tons of opening jobs, but it's a competition.
Right.
Every employer is competing for the right workers.
Right.
It's crazy. This is a dilemma for the Fed.
Absolutely.
And I think a big thing looking at this and the story of inflation is we were all cooped up at home for a while, and now everybody's like, I want to get out, I want to travel, I want to have experience concerts. I mean,
Right.
you hear Beyonce's tour overseas.
Taylor Swift,
Yeah, Taylor Swift, all this stimulation. People want to go and spend money, hotels, restaurants. And you look at the services piece of inflation and how much that is. And like Rich said, you see people hiring at hotels or restaurants. We'll pay you $15 an hour, $20 an hour. I mean, minimum wage.
My
still
kids
10,
just got jobs at $14 an hour.
Yeah,
exactly.
I mean,
Yeah.
they're 17.
Right, exactly.
Yeah.
So
That's amazing.
That's
That
really
is
amazing.
incredible.
I was getting paid like $8 an
Yeah,
hour when I was that
I mean,
age. So,
it's just wild.
But it goes back to all the wage stuff, and that's the issues they're having.
right.
Yeah, I mean, wages are up, which is great because a lot of these folks, they're not feeling the inflation.
Right.
They're feeling it in interest rates today, and they're feeling it in home prices today. But remember eggs were $15 a dozen? Well, eggs are back down to pretty much pre-COVID
Right.
levels. And a lot of things come into factor when we talk about the eggs thing that nobody ever did. But, like bird flu and
Right.
all of that, or is it called bird flu?
Just
Yeah,
things,
whatever that
things,
was.
Things happen.
Yeah,
like
so-
Tyson Farms.
Yeah,
and all that stuff.
like the pork and the product, but food prices are still elevated, but way lower, which is obviously the reason we're seeing the CPI come
yeah,
down.
the
so.
food component is a.
But people
definitely-
have money.
Yep.
That's the point. That's why the Fed it's a fight because people are spending, they're happy to spend, and they're making great money.
Right. So.
It's hard.
Yeah,
Like,
so-
what do you cut?
Yeah.
Yeah, so when we look at this data, this is a case for them to keep hiking. And so when
Right.
I tell people there's three things the Fed can do when they meet. They can pause, like they did last time, they can cut, or they can hike.
Okay.
And they just told us they're not necessarily done considering hiking maybe two more
Yeah,
times.
and I think this is one of the things that they're looking at.
This is a
Shelter
case
was
for
also
them.
something that they talked about in their last meeting, but this with the tight labor market a big
Yeah.
component. So let's jump into the next segment, which we're going to focus specifically on the Houston market and give you an update on that. So on this next slide, I'm showing a couple different things. So on the left-hand side, I'm showing Harris County total sales so total units, townhomes, condos, single-family residences, 2019 versus this year. The reason why I'm choosing 2019 is because 2020 was crazy because of the pandemic, and then 21 and 22 were anomalous because of the low interest rates.
I've heard realtors call it 20, 21, 22 the unicorn years.
Right. Yeah.
So
they were.
So take the unicorn years out of it.
We'll exclude those and then just compare to 2019, and you can see that for the first part of the, at least the first 3 months, we were actually right in line with that 2019 numbers, a little bit above. We've kind of dropped below. Part of that might have to do with interest rates increasing in May, but so it's interesting that we're not hugely behind that pre-COVID-19 level, which is interesting given the fact that we've seen such a massive increase in interest rates. So at least for Houston, that's signaling that, yeah, while there are some external factors like these interest rates going up, there's still good demand. And we can see that also on the right-hand chart, which is showing the change in monthly prices, again, for townhomes, condos, and single-family residences in Houston. The gray dotted line, that's the 5-year average before COVID, so 2015 to 2019. And then I show 2022 to just sort of see what the crazy year was like, and then where we are in 2023. So I think that the interesting, at least for me, one of the really interesting things about this is that we're not seeing as big of increases, but it's likely that we will not see as big of decreases as well. So if you see that we're below the peaks on the gray line, when you're looking at the green line, that indicates there's some stability in the Houston market, and I think at least some of that has to do with inventory. Rich, how are you seeing other markets in the U.S.?
Well, your coasts, obviously, the coasts are going to hurt.
Right.
They're probably going to lose a little value. We've seen a little bit of price reduction in on the coastal areas and Phoenix, which is my market, but they also saw the biggest increases. But we're unlike other booms that we've had in the housing market, like California is always, and then everybody sells and goes and invests that money into another state. Like Tennessee has gotten a lot of West Coast people. So look at that market. It's insane.
Right.
Now, that market will likely lose some value. Texas has always been one of the most stable states for housing.
Wow.
It's incredible. There's a lot of good lending laws in place, and people, people are proud in Texas, and they take care of their properties, and that keeps values up, and it's just a great state to live in for sure.
And at least in Houston, our exposure to the sorts of industries, we have big exposure to healthcare, big exposure to oil and gas, and actually a large exposure to government jobs. Around 10% of the jobs in Houston are government-related jobs. So if you just think about if we are going to go into a recession, those sorts of industries tend to do well relative to other industries. Like if you're comparing to the technology industry, which tends to be more hit harder during a recession.
Yeah, I would just say our local economy is very resilient, with the type of economy we have. But Rich, when I look at these numbers, we're thinking about demand is strong, and what causes demand destruction? You kind of answered it earlier. It's like loss of jobs, not having income. You know? And it's like that's not happening right now.
Yeah, the problem today, you got plenty of buyers.
Yeah.
You got plenty of young people with money that want to own a home. The problem today is inventory, and that's for those of you watching this, especially your agents. They know.
Yeah.
They're seeing the listings. They know where it's at, and that's what's keeping prices stable too. Is that when a property does come on, the sellers negotiate a little bit. At least more than they were during COVID,
right.
And it's keeping the market stable. And that for home buyers that bought during COVID, that's what you want. You want stability. Because people were concerned, am I paying too much for this home during those years? And maybe you did, but the demand in the market dictated that. So, we've moved forward, and you're likely to keep that value.
Yeah, absolutely.
In Texas.
Yeah.
This is an incredible state for maintaining its value.
Yeah, and one of the reasons why we have such low inventory is because so many people have low interest rates on their mortgages currently, and they're hesitant to sell and then have to buy into a larger, have to get a higher interest rate. But on this next slide, I'm basically showing the inventory from HAR.com. I pulled this on the 12th, and you can basically see that months of inventory in Houston is at 2.4. Okay, so a neutral market
makes me nauseous.
A neutral market.
2 months, guys.
A neutral market is going to be 4 to 6 months, right?
Yeah.
So we're half of that right now, which is, again, speaking to why we're probably going to see some more price stability, not see as large decreases, at least in the Houston area, that in conjunction with what Rich was just saying about jobs. On this next slide, I think it's really interesting. We're basically showing the inventory in the Houston Heights. And we really like this slide because it, visually just shows what the inventory, the reality of the inventory situation. So what I'm showing on the left-hand screenshot is the number of houses, single-family residence, townhomes, and condos for lease in the Heights currently. So this was pulled a couple of days ago, that are under $3,500. And you can see there's lots of them. And then if you look over to the right, these are the houses for sale that are under $450,000, again, single-family residence, townhomes, and condos. And there's really only about 20 in the whole Houston Heights.
A picture is worth 1,000 words. I mean, this right here is crazy.
I mean, I look at that chart for all the homes under $3,500 per month for lease. That excites me a little bit, because those are investors that have bought homes, whether they've owned them for years or they bought during COVID when everybody was rushing out to buy properties. These are going to be the years where maybe, prices have peaked. So a lot of these investors are going to want to exercise and pull out their equity in those homes and sell them at this point. And rents are coming down, so the return on investment is a little bit lower than it was. Right? Taxes are going up, and then
they are.
Investors have to pay for those, and you can't charge more than $3,500. I mean, for lease, it's very hard. You limit who would qualify, who would want to pay that to rent a property. So I look at that chart and I say that's a lot of future listings, maybe in the next 6 months. And we really need it. So I hope that happens.
100%. Okay, so on this last one, this is a chart that we've pulled up quite a few times during our podcast, but we love it, and so that's why we keep showing it. So what I've done is I've looked at all the biggest Houston area employers, and I had the list beneath the chart of who I'm including there. So these are large, publicly traded, so they have stock prices, and they have a large employment present in Houston. So people like ExxonMobil or Halliburton or HP. And so I put them on their own index, and I'm comparing them versus the S&P 500, which is a proxy for the wider stock market. And what you can see is the blue line is well above the red line, and it has been so since about the beginning of 2022. So this signals that the companies that employ a lot of people in Houston that are publicly traded are outperforming the market, which is a good signal for the employment prospects for those companies and also just their overall profitability, which both of those components I think are good signals for the Houston market.
Yeah, companies that are making money are hiring people, relocating people. I know we get phone calls all the time from oil companies, people moving from Canada, people moving from Denmark or the UK and the North Sea, and they're moving into Houston. And so these companies are hiring and promoting constantly right now.
Good things are happening.
Yeah, absolutely. And
this is a good slide to show every single time.
Yeah.
We see so many bad slides. We're going to ride this horse until
we love our Houston, and Houston is strong.
Absolutely. Definitely compared to other markets.
Sure.
All right, we're going to jump into this next section, and here we want to have Rich talk us through, some of his experiences in the past and sort of how to speak some confidence and some knowledge into the market where there's so much fear presiding, and also just to talk through what do top producing real estate brokerages and agents do to be successful in the type of market that we're in. So
well, I would say if for our agents that are viewing this and any mortgage people that are viewing this, I mean we have to work as a team to keep our buyers motivated and positive, because it's a street fight right now to get under contract. It's all mindset. It's just like I try to discount that was a manufactured event, those unicorn years. But that's a base knowledge for a lot of people. They think that's where rates should be, and it's not. It's not going to be there. So what we need to do is put some perspective where the market is, and keep our buyers motivated. Keep them going, keep them positive, do different things. Right now, agents, I talk to agents all the time, and the biggest thing that's happening agents are now taking this time period to really build their database. And for us in this business, we're all about database. But agents, I mean, I'm looking at you guys, 80% of agents don't manage a database. They don't manage their database. And they may have a database and it's their phone. You know, when was the last time you talked to a client that you sold a home to 6 months ago? Most people would say, I haven't.
They're just very passive with how they manage their
Yeah,
database.
and that is gold. The data that you have is gold and you need to use it. And one tip I would give for that is create an event. Like, you know your past clients, your prospective clients. Create an event like a movie screening. Go through your database, call everybody, update contact information, update email addresses and cell phone numbers and whatever it is. But make the call, update everything, and set it up as, hey, I'm going to be doing an event for all my past clients. I'm trying to make sure I have all the right information. And then use that data that you've just recently updated to keep marketing to those folks, because your past clients, that's your gold. Because those folks, unless you ask them to refer you to somebody, they likely won't. The answer is always no unless you ask.
Right.
So I would create an event, dig into that database, make sure your data is solid, and create an event. Get out there and get in front of your people, because that's where the gold is. And stay positive. It's hard. There's so much negative news today. You need to talk when you're making these calls. Yes, I know prices are up. It's great for your current property. You know what I mean? Like, remind all the good things. And what are you doing? When are your kids going to start to buy? Do you have any family members that are looking right now? You need to ask those questions. And it's easy to do when you have a reason to call.
Right.
So create a reason to call and go after it. Get after it. Have conversations, because listen, it's not like you're gonna spend an afternoon making phone calls and you're gonna come away with a few transactions 30 days later.
Right.
You have to seed your fields. You gotta start putting seeds in the ground, and they're going to develop. And it's easy to stay positive. You just have to have the right mindset. If you're consuming a bunch of negative stuff, what you're going to put out is negative stuff. Read great books, read positive news, dig into some of the charts that are actually really good about our economy and about housing today, and share that with people, because that mindset will change. And that's what we need. We just need a lot of positivity, because there is so much out there, it's just not highlighted.
Right.
It's like pushed aside because negative sells. And
Yeah. Rich, you always say this to me, I remember this, there's 3 things you can work on when times are slow. You can work on your mindset, you work on your skill set, and you can work on your tool set.
That's
right?
it.
And when things were busy in COVID, you're like, I don't have time to work on
oh
any
no,
of that
everything
stuff.
was out.
But now we have time to work on those things.
We sure do. And you have time to share it with your counterparts in your office. It's great. There's a lot of teams doing great things right now. What I would encourage people to do, all of your young buyers, they are not calling you. They're combing through socials, they're combing through the internet to look at properties and listen to what's happening. So put good content, do video. Get it. You don't need every single cell phone has a great video camera. Use a cell phone, have good lighting, and have good audio and a great message, and put it out.
Yep.
Put it on your socials, share it. Put some positivity out in the market. Tell them what you're doing. Tell them how great the market is, and they're going to reach out to you. That's just what's going to happen.
Yeah. One of my favorite things to always remind our LOs and even our realtors, like, when you enjoy what you're doing and it's obvious to other people, they want to work with you. I know when I hire someone to work in my yard or whatever it is, like, man, that person really enjoys what they do and they're having fun with what they're doing, and it just draws me in to want to work with that person. So let people know you enjoy what you do and you have fun doing what you do. You will attract the right type of clients.
Great example. On socials, I've been into TikTok. My kids got me into TikTok recently, and it's a really great platform, and I hope we work out the issues that we have with TikTok, the U.S. But it's a great platform, and there's a lot of good things happening there. For example, there was a guy that was cleaning homes. Like, he would go walk up, knock on doors. Hey, I see your yard is a little out of control. I'd like to do it for free. And he films his work and the before and after. And he says, hey, if you like what I'm doing, I'd love to work for you. And he says, this is what I do, to market myself. I take care of neighborhoods. I keep neighborhoods looking good for people that can't afford the business. But if you have a landscaper that isn't doing this kind of thing, please give me a shot.
Yeah.
Let me earn it. This is what I do to earn your business.
That's awesome.
So that's the things that attracts people. I called the guy, and that guy is now doing my yard.
No way.
Yeah, I mean that's what happens.
That's awesome.
And this is not
That's just
it doesn't
2023.
happen
Yeah.
every single day, but this is the new age marketing.
Mm-hmm.
You have to earn it. You have to tell people, this is why I want you to use me.
Right.
I'm special, and here's how I'm special. And it works. So what are you special about? Like, what is special about you? And tell people about it, because that's what attracts people and your clients.
Man, that's so
That's
good.
awesome. All right.
So good.
Well, we got to end it there because
Let's
that was
do it.
just too good. So just to give a quick recap, a summary of what we've talked about. So we talked about the debt ceiling negotiations. We
Yeah.
talked about the Fed raising its not raising its rate,
Pausing.
pausing its rate,
A hawkish pause.
a hawkish pause, maybe raising it a couple more times this year. We saw the May inflation data come out, the CPI, that showed that we're still making progress on inflation. So that's very good. We talked about the impact from the debt ceiling. We've seen that rates have went up, but have come back down a little bit since that was solved. We talked about the Houston market, that it's still, on average, still performing pretty well, especially relative to other markets and even relative to history. And then, of course, we ended with some great tips with Rich on how to be successful during this market. So we really appreciate y'all tuning into this episode. We look forward to seeing y'all next time, and have a great day.
All right, see you guys. Adios.